Hey, good morning, everyone. Happy Tuesday. It is Tuesday, August 8th, and I'm finally back in Bulgaria after a birthday weekend celebration. I hope you all had a great weekend, and I'm finally back in front of the computers, finally back in front of the screens here, in front of the charts, and let's see what is cooking. So, we got a bit of news here out of China, some trouble in China. 2023 was the year that China's economy was supposed to come roaring back following the end of its zero COVID policy. But all the indicators are pointing in the opposite direction as it shows, right? Data does show slowing growth and soaring youth unemployment. And there are many signs that deflation might be a bigger problem than previously imagined. The latest data today showed that Chinese exports suffered their worst fall since the start of the pandemic, while its CPI came in flat in June, and producers' prices have gone into a tailspin. Now, keep in mind, we also have CPI inflation data that comes out this week for the U.S. economy, and we'll talk more about that as a trade plan as well for what I see for the remainder of the week and what I can see for today. But let's focus here on China and kind of break down what's happening because China ended its zero COVID policy when a rising global inflation had already dented demand for its exports. And compared to the industrialized countries, there wasn't as much excess savings to spend. Their stimulus may be challenging given China's big debt problem and also weakness of the yuan. Bubbles in the property market have also led to many to reassess their net worth, while an escalating trade war has seen manufacturing from Western multinationals outsourced to other countries like India and Vietnam. So, meanwhile, crackdowns in recent years have left the private sector reeling. The suspension of Ant Group's IPO and the Diddy global fiasco soured investment, while Beijing has led targeted campaigns against industries like media, education, and even food delivery, sapping the confidence of the business community. The Chinese government is also trying to repair some of the damage that by courting big US industry players like JP Morgan's Jamie Dimon and Elon Musk's Tesla, but the restrictions on economic activity have prompted many Chinese citizens and companies to save their cash rather than spend or invest. So, deflation could beget deflation expectations, which may see demand suffer as consumers hold off on more purchases. And businesses would also make less revenue if they cut prices, meaning fewer jobs and reduced wages and eventually lower consumption. So we'll see how the macro state and the GDP in China kind of come about over the next few months and quarters. There's also a credit watch in the US talking about the Moody's credit cut ratings on multiple small and mid-sized banks and placed six large lenders on review for downgrade to reflect US banking stresses. So many banks' Q2 results showed growing profitability pressures that will reduce their ability to generate internal capital. This is what Moody's warned. Given that its base case for its mild recession in early 2024, it also raised concerns over small and mid-sized banks with greater exposure to commercial real estate, especially in construction and office lending. Among the downgraded banks were M&T Bank, MTB, and Pinnacle Financial, PNFP, while the lenders on watch for downgraded included US Bank Corp, which is USB, and also Truist Financial's TFC. So, um, I'm going to talk about a little more about what we got in terms of the overall market and CPI because we're in a state where realistically there is some fragile movement, especially for the sell side, right? The sell side tried to open up. It's been pushing, but we haven't seen any necessary large players come in and try to push things lower too aggressively. So what I can see in this market, right? We only have a few days until CPI comes out on Thursday. We have today and tomorrow. The sellers are gonna have to make a move, and we've seen decent reoffers that have held key levels on the S&P 500 futures, but I need to see some more sell side try and push this thing lower if we're going to see that downside press. Now, I don't necessarily see too much downside press coming out. I think that CPI is in a stage where we're starting to get cooler and cooler inflation data that can prompt the flip to the upside for the remainder of the month rally in August. But if we get a hotter print, I can foresee maybe like end of week sell side before we start looking higher. Regardless of the CPI data, I think around the CPI news event, we're going to see the flip to the long side, and it might be very shallow, right? The S&P is struggling to really maintain under 44.96 right now on the future side. So if there's going to be downside today and tomorrow, it does have to come out, and I want to see them reoffer 45.12 and or 45.25, right? Those are the two main areas that I'd like to see the sell side come in. Much higher than that, right? You start just rotating in the range and in the distribution, which could prompt just general sideways movement that could really, really push away the sellers. The sellers need to open up their pockets and really, really push contracts to the downside, and it'll happen in a more aggressive manner with volume. So that's what I'm looking for. I think they're still running out of steam. Markets are generally down from yesterday's close that started the week off. And with that being said, good morning, Vast West. And with that being said, there's not really too much else to talk about. I still like the sell side, but you start making moves above 45.25 and actually sustaining a bit above there, it gets a little wonky, right? Like you got to start breaking 44.96. You got to start seeing some of these sellers try and press this market. Otherwise, it is difficult for them to open this up. So that's what I'm going to be looking at today. See if the sellers can come in at those key areas 45, 10, 12, which we've already started to see some sellers off of that area here pre-market. And I think max 45, like 20 to 25, I would say, right? I don't want to necessarily see prices too much above that area. Tech, on the other hand, is also very weak. It's a weaker market, and I can see tech pulling down more aggressively, especially on the back of Apple and Amazon earnings. Apple earnings whiffed fairly aggressively, very shockingly, in my opinion, but Apple earnings did whiff, and we saw a decent downside. The things down about like maybe 6-7% from the close before the gap. So down fairly heavily. I think that it could pull down slightly more before people start looking at it as a buying the dip opportunity. I think like on a longer term investment area, it's not the worst area to pick it up into the 170s, 175s. So we'll see how that does shape up. I know it's very overextended along with other tech names, so be very cautious in that regard. With that being said, what we're going to do now is open up our live futures room, and it's the first time I've been there in 2 full sessions, so it's going to be very interesting to see. Nothing's really changed in the market, but it's going to be fun to be back. So I hope to see you all in there. We have a free futures course on our website, so go check that out. And we'll be back tomorrow and the rest of the week to wrap this week up. So thanks for watching, and we'll see you guys soon.